So what I have done is I have summarized the content because it's a pretty long article and there's a video which we will stream. So before going to the video, I want you guys to know a particular topic from like derivatives. Its part like contango and backwardation. So I will just introduce you guys through that. I hope my screen is visible, guys.
Yep.
Yeah. So basically, gold has like two markets. One is a spot market, and the other one is a futures market. So futures market is basically what these guys are telling, like paper gold. So there is a theory in the futures market where this theory is known as theory of storage. So this is based on the idea that whether a futures market is in backwardation or contango depends on the relationship between the costs of storing the commodity for future use and the benefits of holding physical inventory of the commodity. So basically, uh, keep in mind this equation, right? Futures price is equal to spot price for plus storage costs minus convenience yield. So whenever futures price is greater than the spot price, the market is said to be in contango. So this makes sense, right? Because there is a time value of money situated, which you need to bring it on present. So basically, contango is the situation where most of the time things should trade, but there are some other factors like storage cost and convenience yield, which cause uh, commodities like gold to some to go in backwardation sometimes. So storage cost makes sense. Like gold has a like pretty high storage cost, so people usually store their gold with like custodians, and they charge some fees and things like that. Hence, the future price always trades in contango for gold. But what has happened currently is like
What is contango?
the the paper gold has exploded. Like for every 1 ounce of gold in the backing, the I think the video summarizes it like they have been trading like 40 to 50 ounces of paper gold. So that is not feasible in the longer term. So yeah, the people are
Anurag,
considering
what
like
is
convenience yield factor comes into play. And yeah, is somebody speaking?
Yeah, basically Saurabh was asking question, what is contango?
Yeah. So what basically contango is, when futures price is greater than the spot price, that thing is termed as contango. So see at this equation, futures price equals to spot price plus storage cost minus convenience yield. So whenever this sum of these things comes greater than the spot price, the market is said to be in contango, like market is in contango. So that is the thing. Whenever futures price trades greater than the spot price, that market is termed as contango. See here, when the costs of storage outweigh the benefits of holding physical inventory, future markets are more attractive than current inventory. Futures will trade at a higher price than spot, and the market will be in contango. So yeah, basically whenever the futures price will be higher than uh, what spot price, then the market will be in contango. But what currently has happened because of this LBMA crisis, people are demanding the gold, like gold today. So the convenience yield factor is much more prevalent today. Hence, the futures price today is less than spot price, and because of this, currently the gold market in the LBMA and COMEX are like in the backwardation. So here the this thing mentions like conversely, when the benefits of holding physical inventory outweigh the costs of storage, current possession is more attractive than the future possession. Spot prices are higher than futures prices, and the market will be in the backwardation. So basically what is happening, people are demanding physical gold right now. So that is causing convenience yield to rise, and futures price as minus convenience yield is in the formula. The futures price is tending to be less than the spot price. Hence, the current gold market is in backwardation phase.
So
So here is
there are other instrument also like ETF or SGB. So does
yeah.
that also follow the same formula?
I think ETF storage costs are not like that much great, but this formula should be applicable to any commodity and anything which trades in a futures price, like any thing which has a futures market. So that has
ETFs are marked to spot price, I think.
yeah. So, but sometime there might be mispricings, and so, but mostly ETFs, mostly contango and backwardation situations happens to commodities, physical commodities. But yeah, ETFs, I think if like there might be some exceptional cases, but uh, futures prices tend to like uh, commodities basically have the contango and backwardation market in general. As Bala said, or if I'm not wrong, Bala was the only one who pointed out, ETFs are priced at spot, so they tend to not have these kinds of market. But yeah, uh, commodities have the contango and backwardation markets. So the today's question, like today's video would be around backwardation, but we have to consider why is gold always in contango, right? Some commentators speculate that gold is always in contango because of its storage cost. So as I discussed earlier, storage costs for gold are too high, comparatively smaller ratio given its worth. But when you consider like other assets or things like that, yeah, contango makes sense to gold. And even if we consider the time value of money, we have to like give like discount the future value to the present. So contango makes sense anytime, but currently what's happening, we'll see in the video. However, that's not always the case. Gold can also trade in backwardation. For example, if a supply shortage emerges, so currently this thing is happening. Supply shortage has emerged in the LBMA, like London Bank, London Bullion Market Association is like facing supply shortages. Like they don't have enough physical gold in backing currently. Or if dollar interest rates drop below the gold lease rates, it would drive demand for immediate purchases. So whenever the convenience yield factor rises, the markets will go in backwardation. So currently the convenience yield, like convenience yield is what, basically to hold that asset physically with you. That is basically convenience. So the convenience yield is in like crop markets also, like tomatoes or cotton. These things have a convenience yield, so you can make something out of it. That's known as convenience. Like you can do something of tomatoes or you can do something of cotton, but if you have stored that thing, that will come under the storage cost. So I think it is clear what is contango and what is backwardation to you guys now.
And like now, is the convenience yield high, relatively
Yeah,
high, or
now is the convenience yield high because the LBMA is broken currently. So people are demanding physical gold with them. So this raises convenience yield. Convenience yield is basically to hold your asset with you right now instead of custodying it with somebody.
right?
Yeah. So
Maybe I can
yeah,
add
yeah,
a little bit there. This
yeah,
backwardation
yeah. Finish. Go
is
for it.
is is possibly most common in commodities which have a high storage cost, right? I mean, sorry, this contango is quite common with. In fact, this backwardation is quite common in gold markets. It's has a higher degree of occurring in gold market over, let's say, a crude market. If you think about a crude market, uh, storage cost for crude oil is substantially high. So you would not expect crude market to go into a backwardation often. Uh, while something like a gold, which can be stored at a fairly low, storage costs and has a high convenience yield, is where this kind of things is more common. Uh,
Yeah, backwardation is more common to gold, right?
Something like equities and all the other assets that we commonly see, equity futures or equity forwards, this does not happen often because there's almost zero storage costs and zero convenience yield too. There's
Hmm.
only time value which compounds it.
Yeah, yeah. So if you guys don't have any further questions, we can go into the video.
Like, I think a classic case, good example to think about this is when crude one-day futures went into negative, right? Last
Yeah,
time.
yeah. Actually, I was about to tell you, like, yeah, in the COVID crisis, right?
That's because the storage cost is
Yeah. Hmm. Basically, the Saudi people were paying you to store the crude, which is continuously pumped out of the ground. Yeah. So I think there is no question. So I am muting myself and going in the video.
Gold is up 46% in less than a year. That's double the gains of the Nasdaq and the S&P 500 in the same period. A historic bull run for gold. But when gold moves like this, it's never just about inflation or market demand. It means something is breaking in the global monetary system, and most people have no idea why. And here's the shocking part. This surge isn't just another rally. It's a deeper crisis that's triggering the biggest shakeup in the gold market in a century. So in this video, I'm gonna break down what's really behind the gold price surge, why the paper gold system is on the brink of collapse, two possible outcomes from here, and we'll look back to history to see when this has happened before, and of course, what you need to be doing to prepare for this. Now, real quick, I'm Mark Moss. I've built and exited multiple tech companies, invested through several, and I make these videos to look at the news or any kind of financial or economic data, then you already know that the price of gold is completely surging. But what you don't know is why and what is going on beneath the surface, the fundamental system that's causing this to happen. Now, as I always tell you, you can get the news from anywhere. What I'm trying to do is give you the reading between the lines. What's really going on? So we'll look at that. Now, of course, most people think that it's because central banks are buying up massive amounts of gold. And they are. They're buying records amounts. Central banks' hunger for gold shows no sign of being quelled this year. This was just February 5th. So there's no signs that their appetite, their desire for gold is going to be quelled. So we have central banks buying massive amounts. Now, to put this, I always like to show you the charts and the graphs so you can understand this. This is central bank gold buying. This goes back to 2010. And you can see how much they were buying here. 2011, 12, 13. We had a little dip here in 2020, 2021. And look at how much this new baseline we're at. This is over 1,000 tons that they're adding every single year. Right here, this blue line is the average that they're on. So something happened. These years, 2018, 2019, were a little bit above average. But something happened right here, 22, 23, and 24, that have changed the appetite for gold from governments and central banks. What could it be? Well, two things. Number one, it could be, you remember right here, the massive amounts of debasement, monetary debasement of government printing, spending, if you will, that happened right here. So in times of massive monetary debasement, central banks are going to do what they do, which is try to protect their wealth with gold. Also, what happened right around here, 2022, was when the Russia-Ukraine war broke out. The United States and NATO decided to seize, basically, Russia's bank accounts, and all the governments of the world were put on notice that your savings in the financial system are not safe, and you might want something physical like this. Two big catalysts that happened and changed that. And of course, since we've seen that massive demand for gold, we've seen the price continue to go up higher and higher and higher. Now, some of you look at things way too short, and yes, gold went down, and yes, it went down, and yes, it went down. But you can see the trend is going up. So if you're a long-time investor, long-term thinker like I am, then you know that you just want to continue to hold gold. Here we are at almost about 3,000. Now, there is some things going on beneath the surface that really show us what's going on. I want to break this down for you. What we've been seeing is that there's basically two big gold markets. Well, now there's three, and we're going to talk about that. But the two big ones have been in London, the LBMA, London Bullion Market Association, that's LBMA. And then we have in the United States, we have the COMEX. And what we've been seeing is that the London gold market is facing unprecedented strain. Unprecedented, as in like historic, as in like never seen before. A rapid outflow of gold to the US COMEX warehouses. So the gold is flowing from London, and not just the LBMA, but also the BOE, Bank of England, is flowing from there over into the US markets, the COMEX warehouses, while the LBMA data shows 279 million ounces stored on paper. They show that there's 279 ounces stored at the London vaults as of December 2024. Only 36 million of the 279 million, the float, are theoretically available. So even though they show they have 280 million, theoretically there's only about 36 million available. That means they're short, big time, right? A critical liquidity shortfall against an estimated 380 million ounces of outstanding spot cash contracts. The spot cash contracts, that's going to tell us where we have to go to look next. So there's about 380 million ounces of demand in these contracts, spot cash contracts, but yet there's only 279 on the books, on paper, but the reality is there's only 36 million. Do the math, it's about 10%. Sort of like a fractional reserve banking. And what happens if everybody wants to pull their money out or their gold out? Well, you see a run on the banks, and that's exactly what we're seeing. The current crisis suggests much of the vaulted gold is either pledged to central banks, ETFs, or foreign governments. So it's already pledged. That's why it's not available. Of the 279 million, it's not available. This is part of what is known as rehypothecation. We'll talk more about that in a minute. Okay, now, the real reason that we see the price of gold going up is, yes, because there's massive demand. Why is there massive demand? We already talked about the debasement. We already talked about being able to hold your assets in a way that, you know, governments like the United States can't steal from you. But really, we see these central banks hoarding, and we want to understand the dynamics of these things. So why are central banks accumulating in large quantities? I've already sort of given you some of this. Accumulating gold to diversify reserves, reduce dependency on the US dollar. China, in particular, has been on a gold buying spree for the 17th consecutive month. Now, nobody really knows how much gold China has because nobody can really trust the data coming out of there. Whatever they show us, it's probably 3, 5, maybe even 10 times more than what they have. But we can see here the People's Bank of China, the PBOC, continued a streak of gold purchases. It's diversified its reserves away from the dollar. In February, China divested, meaning sold off treasuries, 22.7 billion in US treasuries, sold the treasuries to buy gold. Strategic move by China reflects a deliberate effort to reduce its dependency on the dollar. Shoot, these treasuries could get taken from us like what happened to Russia. We should probably sell those and buy an asset like gold that can't be taken away. China is not the only country doing this, and it's a massive move. The PBOC acquired 224 tons, of which, and only 62 tons in 2022. So from 62 to 224, they have really stepped up the rate at their buying. Now, sort of, again, trying to understand the differences of these markets, we can see that, again, in London, the LBMA, and now tapping into the BOE, that London's record gold outflow is going into US stockpiles. Now, this is record, again, this is historic, this is unprecedented. We can see here that shrinking by the fastest amount on record as banks, dealers, and speculators fly bullion to New York. So they're all taking it out of the BOE and the LBMA hands and moving it over to the US. So what is going on? Why is all of this gold moving? Well, part of it is because the demand is so high. We're going to get into some of this paper manipulation that's breaking right now. But it's also been because, and we can see I have another chart here just to show you how big this is. I love to show you these charts. So we can see this is the gold inventories in New York at the COMEX, and you can see that they are absolutely exploding. That's what we call parabolic right there. But to understand sort of these mechanics, what we kind of want to understand is what's really been driving this is China. China's insatiable amount of desire for gold, as well as their continued buying, as well as their divesting from treasuries to buy more gold, but more specifically, them setting up the Shanghai Gold Exchange. And what's happened on the Shanghai Gold Exchange is it's sort of meant to break the grip of the paper markets that the US with the COMEX and London with the LBMA have. So gold investors, if you're a gold investor or gold bug, you know this. Been talking about it for years, how manipulated this market is because of the paper gold that's sold against it. And the reason why that's done is because you can't really get the gold out of the market. So you buy them through ETFs, and so then they're able to rehypothecate, meaning loan it out over and over again, and really build up the supply of gold on paper, even though it's not physical. I'm going to talk more about that in a second. But what China did is they launched their Shanghai Gold Exchange, and now it's physically settled. That means that I can go actually redeem and receive my gold. Now, what we're finding is that physical gold today, when you're worried about a run on the bank or a default, you want the physical. And we're seeing a massive premium being paid for physical gold. So when I can buy it for cheaper on one market and sell it for a higher price on another market, that's called arbitrage. That's what traders do, and that's exactly what's been happening. One big factor pulling Western markets upwards, the price of gold upwards, is the arbitrage happening in China. And it's the fact that the Shanghai International Gold Exchange, SGEI, is a physically settled market, which is different from the cash settled markets in the West, the US and London. So you can do your options, you can make your bet on gold, but at the end, you get settled in cash, not physical gold. And China's changing all that. With a physically settled market on the scene, and with that market trading at a significant premium above what the West, the US and London, traders were able to buy up the COMEX or the LBMA futures and then demand delivery. So I bought them cheap and I demand delivery. I don't want just the cash. And then they sell the physical into Shanghai. This is what traders do. Traders exploit arbitrage opportunities. It's sort of like the carry trade in Japan, right? We're always trying to buy low and sell high in different markets at the same time. And China, by setting up this Shanghai Gold Exchange, gives us opportunity for these traders to now buy it for cheaper in London and the US and sell for higher in China. Now, why is it cheaper in the US and London? Well, a couple of reasons. Number one, again, we know that physical gold right now at this point is more in demand. The governments are like, I don't trust anybody else, I want my gold. Also, investors are like doing the same thing. And then what happens is when the traders start getting involved, it starts to push that even more. All right, so that is the mechanics that really started pushing this higher. Now, there's a lot of rumors about China wanting to have a gold-backed currency. I've done videos talking about how the US might even try to preempt China in that. We'll come back to more on that in a minute. Okay, now what we're really seeing is the illusion of the gold market is starting to crack. The paper illusion. Now, we don't really know. I've seen estimates that there are somewhere between 100, 300 to maybe even 500 paper ounces of gold for every one single physical ounce. And again, that's because these funds, the ETFs, they take in gold, the banks, and then they loan it out. And then they loan it out and they loan it out. That's called a rehypothecation. Let me explain how that works. So let's say, for example, for easy use cases, I have a candy bar, but I'm not hungry. I don't want to eat it, so I'm going to loan it to my friend. Now, he has a candy bar in his hand, and he owes me one. So on my books, I shall have a candy bar. But he decides he doesn't want to eat it, and he loans it to the next guy. That guy loans it to the next guy, like the guy loans it to the next guy. Now, there's 5 candy bars in existence. The guy who physically has it, the guy who's owed one, owed one, owed one, I'm owed one. So now there's 5 candy bars on paper, but there's only one actual physical one. But what happens if the guy at the end gets hungry and eats it? Well, now he's eaten 1 candy bar, but 5 candy bars have now disappeared. And so that's what we're seeing when we start to rehypothecate this gold. We start expanding the supply without actually adding it. So we have all these paper claims. What we're seeing, as I said, is now people are like, I want the gold. And so we're seeing that gold bullion has a premium over the paper claims. And that's why it's starting to break this cash settled market. Now, there wasn't a mechanism for this before, which is why it's something new. Now, gold futures contracts opting for delivery are surging. So we have something called backwardation, and this is in the options market. And so what this means is that people are paying more today than they could pay in the future. I'll pay a premium to get it right now rather than waiting for it. And that shows the urgency that's here. We can see that there's been a surge in gold futures contracts opting for delivery. In the order of 28% of registered gold will be required to fulfill orders. So there's massive surge for delivery. Everybody wants the gold. They don't trust the markets. Now, the markets are set up to not have this happen. So it's very difficult for a trader to actually get the gold out of the market. And it's even more difficult to get the gold back into the market. This is a piece that I've taken from Peruvian Bull. Shout out to Peruvian Bull. We'll link to the full article down below if you want to check it out. He did some really good work on this. To take physical delivery, a trader must, 1, hold a long position in a futures contract. So you have to buy the futures contract. And you have to hold it all the way till its expiration. Usually they're trading these things, not holding them all the way to the end. Number 2, issue a delivery notice to the COMEX. There's a lot of paperwork, formalities have to be done, pain in the butt. 3, receive a warehouse receipt, which represents ownership of gold in an approved depository. Key piece, in an approved depository, another hurdle you have to jump through. 4, arrange for physical withdrawal, if desired, which involves additional fees and additional logistics and additional pain in the butt that makes it very difficult. 5, gold is delivered in 100 troy ounce bars, meaning an investor must purchase contracts in multiples of 100 ounces to take delivery. So this is not for small players. This is a 100 ounce minimum. You can do the math. This is a significant amount of capital. COMEX only allows deliveries from a few approved depositories. So now, if you want to take the gold out and then you want to put it back in, that might be a problem because they only allow it from a few approved depositories, such as Brinks, JP Morgan, and Malco Amit. Moving the gold out of these vaults requires additional approvals in transport, logistics, and fees. So again, you can only get it out to a couple places, but that's even more expensive and even more time consuming and so forth. Taking physical delivery is expensive, including storage fees, insurance, transportation costs. If you don't know, gold is heavy. So to take delivery of it is very expensive. But then if the gold is withdrawn for personal storage, it may lose its COMEX good delivery designation, the status making it harder to resell it at market prices. So they do almost everything they can to keep people from taking the physical out. Why? Because they want to retain control of it so they can continue to have it on their books to rehypothecate it over and over and over. That's why 90% of trading is on paper. They can sell naked shorts to depress the price, all of these things. But again, now they're seeing these huge withdrawals and it's moving. And we can see here, that gold, it says here, bullion banks are borrowing GLD. So GLD is one of the biggest gold ETFs out there. Bullion banks are borrowing GLD shares and converting the units to physical and gaining control over the metal. So they're borrowing, they're buying, and they're trying to convert as fast as they can. GLD ETF alert. The borrowing fee on GLD ETF has gone vertical today. Why? Because of the demand for everyone borrowing. They're trying to fix the system, or I should say they're trying to paper over the system, which I'll show you the two options we have for that in a second. But we can see the price of gold set a new record high on Friday. This data shows stockpiles in London. Data showed stockpiles in London shrinking by the fastest amount on record. So again, getting completely drained. Speculators fly bullion to New York. London's gold fixed today above 2075. We don't have to worry about the pricing. But we can see that it's these discrepancies that traders are going after. This is a really cool chart. This is from Shift Gold. And we can see this is gold for deliveries. And so again, you can sort of see this baseline of how much gold is out for delivery. Now, typically January is a very low month. And look at this record that we've set for January 2025. Way above normal, way above where we see January. And so we can see there's this urgency. People are freaking out. They're paying massive premiums to get their hand on the physical. Why is that? That's because the entire fundamental market is shifting. All right, so what's next? Where do we go from here? Well, I really see two options, two ways out. Now, this is a fundamental transformation of the entire gold market, but we only have to look back to history to see when this has happened before. In about 80 years, you know, about every 80 years we have this financial revolution, and we can see exactly what happened last time. So let me show you what history tells us. Now, the first thing is scenario number one, they try to patch the cracks. Of course they're going to. How can we patch the cracks in this scenario to make it look like we don't have a problem? So this gold depository could, on paper, loan more to this gold depository so they could double count them, for example. They could borrow back and forth. But the problem is, now we have a physically settled market. And this is what changed everything. So, as I already showed you, the LBMA has 279 supposedly available on their books, but there's only 36 million available for withdrawal, but there's over 300 million in demand. When that starts to be physically settled, then we have a problem. So what happens is in the beginning, they try to patch the cracks. They try to loan to each other. They try to show that they have it to maybe bring some confidence back into the market, right? Now, it's like if there was a run on the bank, you need to show everybody, hey, you don't need to pull it out. It's very expensive. It's very hard. It's very time consuming to get it out. It's better to keep it here. Look how safe we are. But we can see that they're also trying to help each other out as best we can. Here we have U.S. demand squeezes India's gold supply. Leasing rates rise to records. So they're leasing it, they're borrowing it, they're putting it on their books to make it look like they have it. Now, what we can see, why is it all moving from London, the LBMA and Bank of England, over to the U.S.? Well, the U.S. is also trying to prepare for this. So they're all trying to patch the cracks. But again, history gives us so many valuable lessons. And history shows us what happens in the gold markets when they become over-manipulated and they're trying to patch the cracks. So we can see back here something called the London Gold Pool. Now, you might remember in 1944, we had the Bretton Woods Agreement where the entire world went onto a gold-backed standard. The US dollar would be the reserve currency of the world. It'd be pegged to gold, so 35 US dollars would equal 1 ounce of gold, and then the whole world would peg to the US dollar. But the problem is, pegs never work. Traders are always going to exploit those pegs, and we also have the problem with humans and governments wanting to always print more, manipulate the system. And so we can see this is exactly what happened. Back in the 1960s, we had the London Gold Pool. And so basically this is the same situation, a very similar situation to what we're seeing now. And it was the pooling of gold reserves by a group of 8 central banks. So the United States and 7 European countries. So they all pooled their gold to try to help each other's books to show that they had enough liquidity so they wouldn't break the system down. All right, so on November 1st, 1961, they cooperated in maintaining the Bretton Woods system that was set up in 1944. It was already breaking apart in 1961. That's how quick these things fall apart. the system of fixed rate convertible currencies and defending, this is the whole thing, defending the price of gold at $35 per ounce. And so they did all these interventions in the London gold market, the LBMA. All right, the central banks coordinated concerted methods, working in unison, working together, of gold sales to balance spikes in the market price of gold. So when the price of gold was spiking in different markets, they would work in a concerted way, in a group way, to dump more gold, more supply into the markets to bring those prices back down. But the problem is, again, is that traders will continue to exploit that. And the problem is you start to run out of the gold. And that's exactly what happened. The price controls were successful for 6 years until the system became unworkable. They could no longer suppress and manipulate the price. So China set up their physically settled gold market years ago. We're seeing it coming to an end just like it did here. It says the price of gold peg was too low, and after runs on gold, the British pound and the US dollar occurred. France decided to withdraw from the pool. The London gold pool collapsed in March of 1968. So a few years after they set it up. But think about this here. It says that the price of gold was too low, so the price of gold needed to come up because there was more demand. And after runs on gold, the British pound and the US dollar occurred. And so runs on gold, everyone was trying to get as much gold as they could out of the system, as well as runs on the pound and the dollar. They had to go ahead and drop it. It says right here, but this gold window collapsed in 1971, finally. So the controls followed with an effort to suppress the gold price. They tried to keep the game going for a little bit longer, but it closed officially in 1971 with the Nixon shock, resulted in the onset of the gold bull market, which saw the price of gold appreciate rapidly to US $850 by 1980. So 1971, it was $35. And by 1980, 9 years later, it went from $35 to $850 when the concerted effort, the London pool, when the manipulation broke. And what broke it? The physical demand of that gold. Okay, now what does this mean for all of us? Well, this means that gold is surging. I expect gold to continue surging for the reasons we've already given you. Mainly, governments don't want to hold U.S. treasuries that could be seized from them, like what happened to Russia. Number two, the entire world, not just the U.S., but all the central banks are doing massive monetary stimulus and will continue to increase that monetary stimulus, and so gold will be that inflation hedge. Then we add on top of it the fundamental breaking of the system and this cash-settled market doing that. And so we expect gold to go higher, right? So what the smart money is moving to gold. You and I, we're considered dumb money. Hate to break it to you. The smart money is the institutions, the funds, and central banks. They're all moving to gold. I already showed you the record demand. And what we're seeing is that physical is much more in demand than paper at this point. As I've shown you, they're willing to pay a massive premium for the physical over paper in the system because that paper might not be there. So if you have a bunch of paper gold, you might want to consider moving that into some physical gold that could at least be stored in a vault somewhere else like that. Also, gold mining stocks should continue to do good. I mean, if they've been struggling over the last couple of years, inflation has pushed costs up super high. The price of gold hasn't been moving that much, but with the demand for physical moving up, we might see an increased demand for gold mining. Also, what we're seeing is a massive demand for Bitcoin, which is digital gold. And Bitcoin is not just in demand by retail like us now, it's also Wall Street's institutions and even central banks. I think we have 21 states in the United States doing a Bitcoin reserve or working on one, other nations as well. We've seen Bitcoin move up, I think, 500% over gold in that same time frame. And then most importantly, think about the long term. All right, as I showed you that gold chart in the beginning, nothing moves up or down in a straight line. This will not be a smooth path. We're talking about the change of this 80-year-old system, this financial revolution cycle coming to an end, and an entire new system being introduced. But when this all happens, expect the price of gold to pop $5,000, $10,000, $20,000. I don't think it's if, I think it's a matter of when. And if you want to find out more about that, I did a whole video on this to show you why.
So yeah, this was the video, and basically China doing like physically settled markets triggered the LBMA crisis, like the shortfall. for the gold reserves which they claim.
Can you explain like how China opening a physically settled market? What is the arbitrage that happens here between?
Like what's happening, as the guy mentioned in the video, like the price in the LBMA or COMEX, the futures price is much less than compared to what they are getting after selling that gold in the Shanghai Gold Exchange. So that is causing arbitrage. So what the traders are doing, they are buying the futures and keeping it till until expiration, demanding physical delivery, and then uh, when they take their physical delivery, then they are selling that gold in the Chinese markets. So Chinese markets are, as they are physically settled, that market is demanding a premium at a gold price. So because of that premium, the traders are exploiting this arbitrage opportunity right now.
Okay.
Yeah. Any questions or somebody wants to add something?
Yeah, I believe this can happen in India too. The only challenge is the volumes are much lower with the derivatives. Uh, is my understanding. In any thoughts or any?
Yeah. Indian derivative markets are too small when
Yes,
compared
right,
to like US and
correct.
UK. Yeah.
And also, I believe it is intentionally limited. I mean, I think it just doesn't only. It isn't only with gold. I believe it is also with several other. Say, if one wants to trade, say, US dollars and INR, uh, and then wants to take delivery, and which again will create the same scenario in if it is done here as well. But again, it is somehow limited by regulators, not in terms of all the volumes are very much controlled and limited, and nobody
Yeah.
does any kind of FX trading on any of the Indian brokers or
Yeah.
exchange. Yeah,
Basically, what I know, very few traders take delivery when they trade in futures or like
correct.
these kind of
Yeah,
derivative markets. So yeah, and as the guy mentioned in the video, the exchanges make it too much difficult that traders generally usually don't like take physical delivery. So
correct.
yeah,
Yeah,
that's
and
the reason why they are able to maintain this like paper gold stuff.
correct. And most positions are closed out 2-3 days ahead of time to avoid that overheads of uh, ending up having to take physical delivery. That's also
Yeah, that's true. That's true. Vinay, do you have any point to add in here?
One of the things I read was part of the reason is also the tariffs which are coming in
Yeah.
in
Mm.
anticipation of the tariffs, post which gold can get more expensive, or moving gold across continent can add to the expenses. So a lot of
Mm.
people in New York started expecting physical delivery of these
Yeah.
contracts, because of which the price on those futures went up.
Mm.
And the banks which take the offsetting trade on these futures contract had two options: one to basically take some losses, or move gold from London to New York and settle them in you know in
Yeah.
physical
This
currency.
image explains your point.
Yes.
But what I don't understand is like how does tariffs affect your like tariffs are very targeted. They They are targeted at a specific good, specific country, and I don't remember, or I don't remember Trump talking about tariffs on gold trade and all. But
Yeah, you are right, Bala. Yeah,
He
yeah. Go on,
announced
finish.
tariffs on aluminum and steel, right? So, in anticipation of something that could come up in gold, there was a surge in demand for physical delivery ahead of something that might happen.
Yeah, yeah. I also read around that. There's a speculation in the market, like Trump will do like put tariffs on gold also, but currently we don't have any information regarding that.
and how does this tie into current recent RBI circular on like RBI is willing to take your SGBs and pay you money now?
They also like
Like
uh,
RBI naked, I think they sold naked shop. They don't have any gold.
mhm. Yeah, I was reading about it in the afternoon, but I like don't went didn't went much deeper into it. I am not aware like what RBI is doing right now. Maybe
Yeah,
you can explain a little bit more.
yeah. Basically, 2 days ago they released a circular. Um, like I think they have totally issued like 61 tranches of SGB, and so far only 6 have been redeemed, and they are willing to like the usual contract was you wait till expiry, then surrender the bond and get the market value of gold at that time. Now, what RBI is coming forward is they are willing to preemptively take or extinguish your SGB. So now, um, if you are ready to surrender, you can directly go and do it to RBI. You don't have to sell it in the secondary market and cash out. So originally
Mhm.
this was not meant to be so, but now RBI has released a circular saying that they are willing to take up your SGBs.
Hmm. Yeah,
Yes.
might.
Yeah.
Yeah, go on, JK.
Yeah, I mean, after going through this video, it is quite elaborate and quite concerning also. Like, they are basically anticipating there is a major problem, and that what he was talking about, the crack. And to
Hmm.
fill the crack, they are anticipating the gold prices will go up.
Hmm.
And that could be a proactive step from the government to redeem the SGB bond.
Yeah,
So
correct.
they are anticipating that it is going to go up very sharply, and they have to print a lot more paper to basically pay
Hmm.
all the SGB bondholders.
Yeah.
So yeah, so there is the overall. It is not about the price going up. The underlying problem is something everybody is already aware, and they are taking some corrective action, which is so and that's where I believe the Bitcoin comes in.
Yeah.
Yeah, curious enough, like in Twitter, like more like usually the TradFi guys who dump on Bitcoin, they are like suddenly talking about self custody, not your own gold, not gold, not in your vault, is not your own gold kind of stuffs. It's like very surprising or surprising to see these guys talk about it.
Hmm. Yeah, do you guys remember we had done a session earlier about SAB 122, basically on rehypothecation? So in that we have talked about like Bitcoin ETFs. So here in this video, this guy was mentioning like ETF is also a kind of paper, and
they are also cash settled.
yeah. So Fineng, we have talked about in a session where we discussed about in-kind creation and redemption. So will it be? I mean, will it act like as China settling it physically? So it might like ensure like BTC ETFs will have one BTC for one ETF.
Yeah, so in the ETF world, ETFs are basically asset managers holding ETFs for you, right? That's the buy side of the investment banking business or the financial services business. In buy side and in asset managers, what you are expected is to hold one for one. You are not essentially allowed to rehypothecate that gold. This rehypothecation and fractional reserve system is usually the banks who play this role. Like even in case of FTX, if you remember, right, when FTX went down, CZ came. I mean, what Binance says is we hold one for one, right? What's typically expected from a lot of these, uh, you know, entities which just provide you brokerage services or hold your assets. You're not essentially allowed to pledge your gold, or you're expected to maintain a 1-to-1 of your assets. So I'm not entirely sure, if the ETFs are such a big threat, be it in the Bitcoin world or in gold world. In the event they pledge out your gold or they pledge out your Bitcoin, what's expected from these players is if they make any interest on it, they pass over that interest to you. Since they don't pass over any of that money that they make through pledging and stuff, they're also not expected to, lend it out to anyone. They're not allowed to, in fact.
But this guy mentioned about GLD. So GLD is basically BlackRock's gold ETF. So he mentioned like lending something around that. GLD has.
GLD is one of the biggest ETFs, I think, out there. I don't know if it's BlackRock. I think it's SPDR. I think it's State Streets. I'm not too sure. BlackRock has what is called as iShares gold, physical gold or so.
Okay.
Both these, you might want to check on this IMDAP. They are not, I'm pretty sure the expectation from them is that they don't lend out or rehypothecate the gold that they hold for you.
But from what I read, whatever finance says, right? But the difference between a cash settled and in kind is there is a window of operation for which, like during which the books remain unbalanced. Eventually, they get balanced, but there is some sort of uh, a window in which, like, if you actually go and look at how many bitcoins are backing the ETF units, you will actually find a mismatch. But when the window rolls over, what they do is that they adjust the books and make it look balanced.
So yeah, Google says.
Physically
Google
settled
says
is another idea. I mean that way cash settled and physically settled matters is a lot of people actually do not want physical settlement, right? It's a hassle to take physical settlement, like in case of gold. So they make it easy. It's also an incentive for the people to just settle it in terms of cash rather than take physical delivery. That's another angle or an element to it. They would still be expected to maintain a 1-to-1 backing just to stay void of all market risks, right? Fine, there might be windows where you can have some leeways, but broadly you are expected to have 1-to-1. Maybe once the person redeems, you can take a T+1 or T+2 to settle it in cash after liquidating from that asset.
basically this turns out to be like thing like what Harshad Mehta did in that T+1 or T+2 days, whatever you can do, that thing might they can do it in that time period, T+1 or T+2. But that's a small amount of time, and uh, like doing these kind of stuffs with physical gold, it's extremely hard. So yeah, Google also says that no, SPDR Gold Trust is not allowed to lend out.
What these ETFs usually do is they'll just keep it at one of these vaults, right? I think the gold,
Mhm.
you have these vault companies which just manage these gold for you.
Yeah, just the risk is that the vault will not have gold. That is the risk.
Yeah, any asset manager, is not expected to lend out your assets. They have to park it at a custodian.
Hmm.
They're not even allowed to keep it with themselves. You know what I'm saying?
Yeah.
Gold, or
That's right.
like if you look at iShares Bitcoin or iShares
Hmm.
Gold, iShares is basically BlackRock ETFs. In both cases, BlackRock would be expected to park them at a custodian.
Coinbase custody. Yeah.
But yeah, and redeeming in kind and redeeming in cash is another element. One in kind or in physical settlements. In case of
Hmm.
Bitcoin, it's interesting because that matters a lot, right? Because that determines whether you need to be on fiat ramps or you can be off fiat ramps. If they are just
Yeah.
redeeming in US dollar and not in Bitcoin, you more or less
Hmm.
don't have a way to be off fiat ramps, right?
Hmm.
You have to enter through fiat and you have to exit through fiat.
Fiat. Yeah. I
That's
was
why.
reading somewhere and it claimed around like you should have around 40,000 shares, something, and then you can do like in-kind creation and redemption. Generally, what I have learned in my CFA, this is what it says, like in-kind creation and redemption is done by authorized participants. So anybody can't do this in-kind creation and redemption. But when people were talking in Twitter, things like in-kind creation and redemption, and they were celebrating it, I researched some, but I was not able to find much more info. But yeah, somewhere I read it like they should have 40,000 shares and they can do the in-kind creation and redemption. To the people who are not aware about what is in-kind creation and redemption, is basically like you have a basket where uh, you have a basket of Bitcoin. So, for example, you have one Bitcoin, and you want to exchange that one Bitcoin with IBIT ETF. Then simply you can give one Bitcoin to BlackRock, and they will issue IBIT ETFs to you, and vice versa. Like if you have some a quantity of IBIT, then you can demand uh, that worth of Bitcoin to your wallet. That basically means in-kind creation and redemption.
Yeah, I want to add another thing that I listened with an interview with BlackRock. I think the fund manager. So they are also looking at where they source the bitcoins from when investors purchase their ETF. So that is what they refer to as quality. I mean, so it's also key in terms of so they're just not buying it or sourcing it from anywhere and anywhere, right? So they're sort of having a process where they filter out and KYC a certain set of suppliers for their BTC across the ETFs, and I think this is one of the requirements, not just for BlackRock, several others. So one of the challenges, I mean, just in contrast to uh, not just Bitcoin ETF, but I think the other ETFs that sometimes tend to be in the news. I think a lot of them are challenged by where all of these coins are stored or sourced from. So there is a lack of quality in terms of sources. Uh, yeah,
Hmm.
just wanted to bring up this aspect where you sometimes might hear the word quality with
Hmm.
ETFs, and it basically refers to where the coins are sourced.
Hmm. Hmm. Yeah. Yeah. So, hello, Gordon in the chat says, somebody can sum it up. So, I think he has left. So, do you want guys me for summing it up, or you have any questions further?
We can sum it up and maybe then just hang around here for a bit and have regular discussions around anything else. People want to
Yeah,
Yeah,
add.
I just have one more question. Like how does US revaluing its gold reserve into all these things? Like already there seems to be some kind of a revaluation going on because China just opened a physically settled market.
Hmm.
So, uh, like there is this theory, like Besant or somebody else has expressed earlier that they are also willing to look into the idea of revaluing their gold reserves.
Hmm. Actually, I came across an article, but it was paid. It was an article of Zero Hedge, where the article was talking about this, and the title was QE but not QE, and he was explaining about how Trump's revaluation of gold will take us to quantitative easing, but not calling it quantitative easing. So yeah, if somebody has Zero Hedge subscription, then please let me know.
I can maybe tell a bit about what I read and what they're thinking or what I think they're thinking.
Yeah, yeah, go on.
So I think the big idea they have is US holds about, I don't know the exact number, close to 5,000 tons or maybe 7,000 tons or 8,000 tons of gold in their in Fort Knox, or at least is expected to have that much. That's what they claim, right? That's what US dollar is essentially backed by, and that's valued at around 30. I mean, it's on the books. It's valued at around $35 dollars an ounce or so. What they're saying is thinking about is basically revaluing it to current market standards on their books, which I think again, it'll bring it up to 750 billion or 800 billion in market value, in current market value. What
Hmm.
and then what they're thinking is just the way these banks in London lend out their physical gold. They're thinking, they can also monetize that, and that can be
Hmm.
another source of revenue for them. Lend out and have earn a leasing rate on the
Hmm.
gold deposits that they hold, and make something which will pay for their deficits or expenses. That's, I think, is
I
the
have one question. Like, is this is this a standard practice across all central banks? Like, they acquire some gold and they put it in their balance sheet, and they don't revise the price of the gold in their balance sheet, or how does it work? What does it
it's
mean? Like
not a common practice really. I mean, see, the big idea is like, fine, you manage your books whichever way, whether you value it at market price or book price shouldn't really matter that much. But central banks are often not in this practice of lending out their gold and earning an interest on it, earning a leasing rate on it. I think it's not. I have not at least heard anyone. Central banks manage it to hold as reserves, right? Lending it out and things like that doesn't really serve the purpose of holding it as reserves. So
Yeah,
I
but
think that's
but
not.
my question is, even if it is for the purpose of reserves, uh, shouldn't it be marked to the market?
Market value, yeah. Yeah, actually, I am also not aware about like I came to the fact like sure Fineng mentioned right now like it is marked at $35, so I was like surprised, but I don't know about this thing.
Yeah, it confuses me. Yeah.
Yeah.
Honestly, this
There
whole
is some,
book value is a accounting term, right?
Hmm.
I have never
and
understood why anybody wants to keep it
there was
for a liquid asset like that.
there was something like Basel 3 also, that changed the accounting for banks for the holding the gold. Earlier, for like if they hold for like 1 lakh rupees gold, so they have to mark down like only 50,000 they can keep in account, showing that that much they are holding. But Basel 3 has changed that accounting that they can mark equally. Something like that was there.
Okay. Okay. So
Yes.
guys who are not aware about what is Basel, these are like banking norms kind of a thing where they like come they introduce rules around accounting. So yeah, maybe Basel 3 has
Right.
done that thing according to Chaitanya.
Yes.
Yeah, so maybe I can sum the session up and then we can hang out. So like the summary goes like this: gold's price surge in early 2025. So yeah, this is like on February 5th, but currently gold is trading around $2,938. So yeah, the this happened because structural issues were there in the LBMA because the LBMA and COMEX operate largely on paper gold system. So physical gold supply is highly leveraged, meaning much more paper gold trades than the actual physical reserves. So only 3% of contracts settle in physical gold, while the rest are cash settled. So the price discovery doesn't happen because of this, the cash settled. So what the China did, and they opened the physically settled market of gold. This caused the price discovery, the real price discovery of gold, and this arbitrage situation came forward. So yeah, why gold is centralized and how it trades today. So gold was historically monetary metal, but due to its storage, is now mainly a store of value and hedge against debasement. Microtransaction problem. So gold is impractical for smaller transactions. Yeah, because of that, it leads to centralization in vaults. So instead of direct transactions, gold circulates via bank issued notes or derivatives. So yeah, the LBMA and COMEX primarily trade paper gold, suppressing the real price of physical bullion. The relationship between the gold and QE. Historically, the gold front runs the waves of QE by 12 to 18 months. So this thing triggers that we might see quantitative easing in the coming future. But yeah, it's according to the historical data. Examples like gold surged before the Fed's emergency QE during COVID. Uh, Current rally, China's potential QE. Yeah, there was guys on Twitter who were like explaining how China has like doing QE right now. So yeah, this thing plays out. The Shanghai International Gold Exchange offer physically settled contracts, unlike Western cash settled futures, causing arbitrage opportunities. Yeah. China's China's role in draining Western gold reserves. The SGEI's physically settled market trades at a premium to Western markets. Arbitrageurs buy gold on LBMA slash COMEX and demand physical delivery then sell in China. This has led to massive outflow from gold from the West, putting pressure on LBMA reserves. COMEX and LBMA facing physical gold shortages. So due to this thing, they are facing the physical gold shortages. COMEX typically discourages physical delivery through high costs and logistical difficulties. And yeah, the limit is like 100 ounces of gold bars requiring a large capital commitment. This discourages physical delivery and like suppressing the price. Historical context, 2020 gold shortage and LBMA is fixed. In 2020, LBMA and COMEX faced a physical gold shortage due to massive redemption requests to cover it up. This thing is interesting. The guy, I think, he forgot to cover it in the video, but the article which I have given in the Tradfi channel that covers it. To cover it up, they created enhanced 400 ounce of gold. Yeah, this thing was covered in the video, but this was a temporary fix, but the real shortage was never solved. So January 2025, COMEX braces for redemption crisis, and this is COMEX preparing for the crisis. This was the image which was mentioned, like 19,000 physically settled contracts are pending. So COMEX is preparing via increasing their reserves to settle the contracts physically. The COMEX gold reserves have sharply increased, signaling they are preparing for larger withdrawals. This only happens when physical gold demand surges beyond manageable levels. So yeah, implications: potential LBMA collapse and gold's future. If the physical shortage intensifies, LBMA and COMEX could face liquidity crisis, forcing them to either raise margin requirements, making it harder to trade futures, implement force major refusing physical settlement, introduce more paper contract to suppress price, short-term fix. This could lead to breakdown of confidence in paper gold and further boosting the physical gold premium. So yeah, this was the summary.